மேம் உட்காருங்க மேம். இன்னும் அது பார்க்கல. இந்த ப்ரோக்ராம் வேற ஸ்டார்ட் பண்ணுறேன். ப்ரோக்ராம் ஸ்டார்ட் பண்ணிட்டு நான் லஞ்ச் முடிச்சுட்டு வரேன் மேம். உங்களுக்கு என்ன சப்ஜெக்ட்னு ஓட் ஆஃப் தேங்க்ஸும்
அவங்களுக்கு அது தெரியுமா?
அவங்களுக்கு அதுதான் நேத்து இன்வைட் போட்டேன் பாத்தீங்களா?
என்னோட ப்ரோக்ராம்க்கு நீங்க இன்வைட்டே போடல.
என்ன போடல
பாருங்க
பாருங்க. என்ன
என் பேரை போட்டு வரல
என்ன யோ இதுயா காமியா
பாருங்க.
அது எப்படி அப்படி நான் விட்டேன். என்னது டே 5 கரெக்டா? டே 5ல என்ன இருக்கு? What is this? FTP 1 2 3 எல்லாருக்கும் அமைச்சிருக்கேன்.
டெய்லி இந்த இன்விடேஷன் போடுறீங்க. சரி
நான் அப்படிலாம் விட மாட்டேன்.
நெட் இருக்குது, இதுல 2 GB இருக்குது, அதுல 2 GB இருக்குது.
The best of fashion from India's fashion expert.
சூப்பரா இருக்குப்பா.
மியூட் பண்ணுங்க.
இது அங்கே வரேன்டா. அந்த செங்க என்ன வரல.
அது இன்னும் மியூட் இருக்குல நீ பேசுறது கேட்கும்.
மீட்டிங் மேம் வந்தாங்களா? ஓகே, தேங்க்யூ.
Hi, good afternoon to all of you. My apologies. There was some technical issue which took little time. So sorry for joining in little late.
No problem, sir. Welcome, sir.
Thank you.
Ma'am, Professor Shivashankari, ma'am, can we?
Yes, sir.
start?
Yes, sir.
Yeah. Sir, with your permission, we can.
Surely, please.
Yeah.
Okay. Happy afternoon to one and all present here. I'm happy to be one among you all, and it's my privilege to welcome you all for this FD on the topic creating wealth with mutual funds. Under that, basics of mutual fund structure, asset allocation, key regulations, categories of mutual fund schemes, active and passive investment strategies. On behalf of our institution, I welcome all ladies and gentlemen, management, principal, faculty members, research scholars, our source-rich, resourceful person, Mr. Ravindra Singh Chawla, founder and managing partner, RSC Skill Building and Consulting Solution LLP, and all the participants for this FD. As Henry Ford said, coming together is a beginning, keeping together is progress, working together is success. We are here together to reach our success through the progress refreshed by our beginner, Mr. Ravindra Singh Chawla, sir. I once again welcome you all. A gentle reminder, kindly stay with us till the end of the session and answer the MCQ question type quiz based on learning of the day over Google Forms, which is mandatory to receive the e-certificate. Now, I forward the session to you, sir. The session is yours.
Thank you. Thank you very much, madam, for the warm welcome and introduction, kind introduction. Good afternoon to all of you. It's indeed a pleasure being here with you all. So I'll just share the presentation and we'll start. Okay, so let's start. So creating wealth with mutual funds. Yesterday there was a question, from someone who wanted to know about effective yield. Is it sir here today? I thought that couldn't get clarified properly, so I would want to talk about it today to start with. Is that professor here today who had asked that question? Sir, are you there? Because since you had asked that question, I would want to explain it, and then we'll talk about other things. I don't have the chat record, so I can't make out who had asked that question. If anybody knows about it, just help me know if that participant is here today. Okay. Okay, madam, fine. Thank you so much. Okay, so quickly speaking, let's first talk about it. See, let's understand that there are two ways by which you would be receiving money, right? One way is this, let me write here itself. One way is that you would be receiving money. Let's say in a bond, you receive it at the end of the year, the interest which you receive at the end of the year, right? The other way is this, that you may be receiving the interest on a half-yearly basis, right? Which means you receive the interest every 6 months. Okay? So you tell me effectively whose yield will be higher? The one which you are receiving on a half-yearly basis, or the one which you are receiving once in a year? Obviously, the one which you are receiving interest on a half yearly basis, the effective yield would be higher. Effective means what would be the ultimate return which you are going to get, right? Because if you are receiving the interest on a half yearly basis, you can reinvest that interest every 6 months, isn't it? Similarly, imagine if I get interest on a monthly basis, right? Then I can reinvest that interest on a monthly basis. So effectively, the yearly return to me would be higher, right? If I am reinvesting the interest on a monthly basis, right? So whether I reinvest or not, that is a different thing. In terms of calculation of return, the effective return in case of, let's say, equity, or in case of a debt fund, the yield which I am getting effectively would be higher if I am receiving the interest on a periodic basis. It could be half yearly, it could be monthly, it could be quarterly, right? So just to summarize, let's say there are two options. One particular bond is giving me interest once a year. The other bond is giving me interest on a half yearly basis, right? Effectively, the yield would be higher in case of a bond which is giving me interest on a half yearly basis, right? Hope that stands clarified. All right. So to start with the scores of quiz, cumulative scores. So Dr. Pandurangan and Mr. Sasidharan, they are the toppers, full marks for all the 5 days of FDP, 25 out of 25. Heartiest congratulations, great job, applause and appreciation from my side. The scores of other people, top 23 is in front of you, right? So as you could see, there are a lot of participants who are on 23. 3 participants are on 23 out of 25, and this is what it looks like, right? So really appreciate. Just 2 days left. So today's quiz would also be there, and then we'll have quiz tomorrow also. So next day, although the faculty development program would be ending tomorrow, on the group, I am sure sir would be updating the final scores for tomorrow's quiz also. All right, so let's get going. So let's go about what is it that we should be learning about today. We learn about the basics of mutual fund, the structure of mutual funds. What are the mutual fund scheme categories? What does active and passive investment mean? We'll learn about that. What are the risks in mutual fund? We shall try to learn that also. And then we shall also, in case we are left with time, as we'll take that tomorrow, how to compare risk-adjusted returns. Now, as we are learning, hopefully, we should have time that I'll also take you to moneycontrol.com website, and we'll actually see the performance of certain mutual funds, so that next time when you have to invest, you can decide which particular scheme you need to choose, right? All right. So at the end of the day, like we learned in the first session, we would want to achieve our financial goals, right? For us to be able to do that, we would want to accumulate wealth. And I'm sorry, mutual funds are a great way of accumulating wealth, right? How can we create mutual funds? So we'll go through that. All right. Now, there are 2 ways to invest money. For example, we learned about equity markets, right? We learned about debt markets. I also shared with you that even in debt markets, now the government has allowed, the RBI has allowed the investors to participate in the auction themselves, which means individuals can directly hold the bonds. Individuals can also invest directly in shares, right? The other approach is that instead of you just taking decisions, instead of instead of you doing research and identifying which mutual funds would you want to invest in, we go through fund manager, right? So fund managers are the experts who know a lot about investment. They have more knowledge. They would have dedicated teams, right? So we can take a call whether we want to invest directly or we want to go indirectly. We have both the options. Like for example, let's say you want to go from Chennai to Bangalore, right? Bangalore. So you can either drive down yourself or you can sit in a Volvo bus, comfortable Volvo bus, and you can travel both ways, right? Now, many of you would be driving enthusiasts. They would have been loving driving, right? So probably you would say, no, nothing is better than self-driving, and I would love to drive myself, right? Whereas somebody would say, no, let me enjoy watching a movie. I would better listen to music and I'll sit down, relax, I'll sleep. So Volvo bus would be better for me, right? So mutual funds is similar to a Volvo bus. You are relying on a fund manager, a good driver, fund manager who has his own team, right? Whereas direct investment is also quite exciting, but you would need to have, you need to spend a little more time doing the research, understanding the fundamentals of a company, blah, 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 right? So these are the two approaches. You can either invest directly on your own or you can invest indirectly through a fund manager. And that's what happens in mutual funds. So the latter option is what mutual funds are all about. Now, what are the pros and cons of each option? Please tell me. Please write in the chat box. What are the pros and cons? Okay, requesting not to annotate on the screen, please. All right. Yeah. So, what are the pros and cons? What are the disadvantages? So, let's say if you want to invest through mutual funds, right? What would be the disadvantages for you if you were to, let's say, compare it with indirect investment, direct investment in stocks or bonds? So not owner of the company, sorry, I didn't understand. What is not owner of the company? What are the disadvantages of going to of investing indirectly? Directly yourself, right? And what are the advantages of going through mutual funds? Similarly, what could be the disadvantages of going through mutual funds versus versus direct investment? Investing directly in equities or bonds. Yeah. Any thoughts? Okay. Disadvantages are higher risk. So investing directly is more risky. That's what you're saying, right? Because we may not know much about investments. We may not have time to say. You guys are hard pressed for time. As it is, you would have to spend a lot of time preparing for your lectures the next day, right? And then taking exam, checking the answer sheets. Now, because this would have been happening online, obviously you would need to prepare the test papers, upload the test papers, and that too in multiple copies. All those things are there. Yeah, it would be taking a lot of time, right? So Individual cannot predict. Yes, absolutely right, madam. That's another thing. We may not have that much of knowledge, whereas the fund manager would have more knowledge. They would have a dedicated team, right? But at the same time, when you are investing through mutual fund, there would be some expenses involved, right? There would be some expense ratios which would be involved. So let's look at how mutual funds work. So mutual funds actually is a group of investors, right, who decide to pool their money and invest in mutual fund scheme. So multiple investors, they get together and they invest in mutual fund scheme. Now mutual fund scheme, would have a fund manager, and the fund manager would invest on behalf of the investors in bonds, stocks, etc., right? Depending upon the objective of the scheme. Now the scheme will generate returns. So the returns will be distributed back to the investors after the fund deducts its expense ratios. Right? So the mutual fund is not a charity house. It's running a business. So obviously it will be deducting some expenses. Just like the Volvo driver, the Volvo bus would also be, you'll have to take a ticket, no? It will cost you money. It will not be free of cost. Similarly, mutual funds also would have some expense ratios. But the advantage is this, that you don't need to do any research, right? Even a layman who does not have any knowledge can invest in mutual funds, right? You can invest both in terms of SIP also. You can invest in SIP also, systematically also, and you can invest one time also. Both you can do. You can invest in lump sum also, and you can invest systematically, periodically also. Both are there, right? And you get the advantage of professional management, right? That's another advantage, because there are a lot of advantages. So let's go through the advantages. Okay. So the fund management is absolutely done in a proper manner. The mutual fund would have a fund management team. They would have a research team, right? The fund managers would have a lot of experience. They would have years of experience. They would have strong qualifications, right? Their knowledge about equity markets and debt markets, and whichever scheme they are managing would be very good. So you give your money to experts, right? There is ample liquidity which is there, right? You can sell off your schemes whenever you want. Okay. Mutual funds do not invest only in one particular company. They would invest in multiple companies. So there is automatically a lot of diversification also which happens. Okay. We shall learn about concentration risk going forward. But when you invest money in mutual funds, mutual funds will not just invest in 1, 2, 3, 4 companies. They would invest in multiple companies. Now, we may not be able to diversify that much, isn't it? When you invest, when you create a portfolio, you may invest in 1 company, 2 companies, 3 companies, 4 companies, 10 companies, 15 companies. You may not be able to do beyond that after 20, 25 companies. Whereas mutual funds would be able to invest across multiple companies. Right? Then there is a lot of transparency. You can check the portfolio of a fund where all they have invested the money, right? You can very clearly see where have they put in money. So there is complete transparency which is there, right? And the expense ratios are not much. Considering the expertise that is required, considering the professional management which is there, right? The charges are absolutely low, right? So that is why mutual funds are a great way of investing money. So let's understand from a regulatory perspective what exactly mutual funds are and what is the system like. So mutual funds are actually they are set up by a sponsor. So just like a company would have a sponsor, right? Mutual fund is also set up by a sponsor. For example, in case of SBI mutual fund, the State Bank of India, SBI is a sponsor. Right? In case of HDFC mutual fund, HDFC Limited is the sponsor. In case of ICICI Prudential Mutual Fund, ICICI Bank is a sponsor. Right? So the sponsors would set up trustees. Right? So the sponsors would set up trustees, and these trustees would be taking care of AMC, Asset Management Company, which manages the day-to-day affairs of the mutual fund. So it's a three-tier structure: sponsor, trustees, and AMC. So the trustees are the one who would make sure that the mutual fund is operating in line with the regulations of SEBI. Right? Now, investors would come, they would invest money, right? And the mutual fund would invest that money appropriately in line with the objectives of the scheme. Right? So mutual funds would disclose to the investors what is the objective of the scheme. Just imagine you are at Chennai bus stand, the main bus stand, and you see multiple buses. Right? Some bus is going to Coimbatore, some is going to Madurai, some bus is going to Tiruchirappalli, right? Different buses are going towards different directions. Now, depending upon what is your destination, you sit in that bus. Similarly, mutual funds would have multiple schemes. So you can choose the scheme considering your goals and your investment objectives. Right? So, as we discussed, a sponsor would set up a trustee, right? And the trustee would be taking care of the day-to-day affairs of the asset management company. Right? So, asset management company would have various associates, for example, custodians, for example, a fund management team they will have, right? They will have a customer service team. They would have registrar and transfer agents, right? And together they manage the money of the investors. Right? So just to give an example, in case of SBI mutual fund, the sponsor is the SBI. The trustee company is SBI Mutual Fund Trustee Company Private Limited, and the asset management company is SBI Fund Management Private Limited. Okay, who's the custodian? So they have different banks as custodians. So they have HDFC Bank as custodian. They have SBI SG Global Securities Private Limited. Society Generale, this is again a multinational bank. Society Generale, they are also the custodians, and Bank of Nova Scotia for their gold scheme, that is the custodian. Okay, and who is the registrar and transfer agents? CAMS. So we discussed about CAMS sometime back also. So CAMS is the registrar and transfer agents. All right. So you tell me, what are the risks in investing through mutual fund? What are the risks involved in mutual funds? You would have heard, in every advertisement it says mutual funds are subject to market risks. please read the offer documents before investing. Right? So what are these risks which SEBI keeps questioning us about? In every advertisement, they are supposed to mention that. Right? What are the risks involved? Tell me, please. Yes, please. Okay. Investors are not to know the company. Madam, my question is different. What are the risks involved? Okay, what you are saying is that investors do not know where the mutual fund is investing money. No, that's not correct. Mutual funds, they have complete transparency, right? So in fact, we can go to check we will be doing that. If not today, tomorrow we shall be doing that. So you can actually see the portfolio of a mutual fund company, right? So there's complete transparency. Okay. So let's look at the risks involved, right? So first risk is the market risk. Market risk means there is volatility in the market. There are ups and downs in the market, right? Which means you may have invested money, but mutual fund, has invested the money in a particular company. Now the performance of that company turns bad, and because of that, you don't get good returns, right? Obviously, mutual fund is not going to be managed the company it has invested in themselves. They would have invested the money in a company, right? So if the stock price of that company has come down, what can mutual fund do there? Right? So market risks are there. Similarly, if pandemic starts, imagine, and the market comes down because the sentiment goes down, right? It would impact a lot of companies. It would impact the entire market. It's a systematic risk, right? Another risk which is there is concentration risk. What is concentration risk? See, let's say a particular fund, right? So let's say ABC fund, sorry. Let's say a particular fund has invested money in similar kind of companies, right? They have invested money in similar kind of companies. Just imagine that you go and buy oranges and they are all similar kind of oranges, right? Which means if something goes wrong with oranges, let's say, the season gets over, then it would be impacting all the oranges, right? Ultimately, better is you will need to diversify, right? You need to diversify. Diversify means you are investing in different kind of shapes, different kinds of different types of things, right? So if there is concentration risk, then that's a risk in itself. If there is concentration in the portfolio, if the fund is investing in similar kind of companies, the risk is higher, right? So the scheme would invest in similar kind of companies, right? That's a concentration risk. Okay. What is liquidity risk? Now, you would say that, Ravinder, you said that mutual funds have ample liquidity. So what is this liquidity risk? Liquidity risk may be there just in case, imagine that, suddenly a lot of people want to redeem their money. Right? Like it happened sometime back in Franklin Templeton's debt schemes. A couple of their debt schemes, they had a lot of problems because everyone wanted redemptions, right? And it became very difficult for mutual funds to be able to give money, right? Look at banks. I am sure you would have seen that many times, when there is, when people get to know about any problem with a particular bank, people would want to withdraw their money. And then, the bank is not able to give money to everyone. Although people would have their own money in the bank, they cannot withdraw, right? So it's a very rare phenomenon, but theoretically speaking, can it be there? Yes, it can be there, right? It means it could be, again, for example, let's say ELSS scheme, equity link, certain schemes may have a certain lock-in period, right? A certain scheme may have a lock-in period because of which you cannot withdraw money before that. Okay, so let's say if, in ELSS scheme, equity link savings scheme, if there's a lock-in period of 3 years, you cannot withdraw your money before that. Yesterday, we learned about interest rate risk in the debt funds, right? We learned about that if interest rate goes up, the price will come down, the NAV will come down, right? Then the returns will be lesser, right? So that's the kind of interest rate risk which is there even in government bonds. So while government bonds do not have any credit risk, government bonds do have, interest rate risk, right? That risk is there. Okay. So this is applicable in case of debt schemes. So price movements because of interest rate movements, price volatility due to interest rate movements. And the last and but not the least risk we have is credit risk. So this is in case of debt funds, right? Remember, we learned in the debt in the session on debt that except government bonds, there may be credit risk in other schemes, other bonds, and that is why you need to look at the rating, credit rating, right? So that's the credit risk that the mutual fund has invested money with that company, has lent money to that particular company, and now that company is not able to return the principal or principal plus interest, right? And obviously the NAV would get impacted. So these are the risks which are there. Okay. Any questions till now? Or you may write the question. You may write the question in the chat box, and we'll take it up later. So just a repetition: trinity of investments: risk, return, liquidity. This is coming every time. So just to again repeat that these are the trinity of investments: risk, return, and liquidity. Which means when we talk about risk, when you diversify, you are able to reduce the risk, right? Even in even in equity fund. Even in equity fund, right? Suppose you have a portfolio which means in equity schemes also, you have put money in large cap companies, you have put money in mid cap companies, right? You have put money in small cap companies. Your portfolio is diversified, right? The risk would reduce. Okay, so this is what we are talking about. And again, when you create a portfolio, when you are investing through mutual funds, you may invest, let's say, 70% in equity and 30% in debt, in case you want to invest that. So it would depend from investor to investor. As we learned, it depends upon their goals, it depends upon their risk appetite, it depends upon the time horizon, the kind of returns they want, etc. Right? No two investors are the same, as we learned about it. So let's now learn about various kinds of mutual funds, right? So what are the various kinds of mutual fund schemes which are there? Okay. So how do we classify the various kinds of mutual fund scheme, right? So let us look at the different classifications and then we learn about them in detail. So the first classification is in terms of the time flexibility, right? For example, open mutual fund schemes are continuously, on. They are always there, right? But closed-ended scheme may have a certain tenure. So those are closed-ended schemes. They have a certain end period. An open scheme would always continue forever, right? An interval would be a combination of both. So we learn about it. The second one is whether the scheme is actively managed or passively managed. We shall learn about this as well. Okay. The third one is the scheme which is based on the investment objective of the investor. For example, whether you want to, create wealth, right? Whether you are looking at enhancing your wealth or whether you want to get regular income, right? These are two different objectives. So investment objective, we have different kinds of schemes based on different kinds of objective. For example, tax planning could be an objective, right? The investor wants to get some deductions for tax benefits. The investor may want some liquidity, right? So that could be a different one, very high liquidity. That could be a different kind of scheme. Okay. Similarly, the scheme which is based on the type of portfolio. For example, it could be a large cap scheme, it could be a mid cap scheme, it could be a small cap scheme, it could be a multi cap scheme, right? So what kind of portfolio it is? Again, it could be a solutions oriented scheme. For example, there is a scheme for children's education, right? Children's education is a solution oriented scheme. Children's education, right? It's a solution which is there. So the solution is, for example, children's education. So that's a solution oriented scheme, right? Similarly, it could be sectoral scheme, sectoral fund, or a thematic fund. For example, if you recall, when we were learning about equity, we said that the government is going to, spend 1,02,000 crore on infrastructure, right? Now, infrastructure is a theme. So in that theme, the mutual fund would be investing in construction companies. They would invest in paint companies. They would invest in highway, Authority of India, right? They would invest in L&T, right? So infrastructure would be a theme. Similarly, for example, MNC companies, multinational companies could be a theme. So multinational companies could mean company which is into fast-moving consumer goods also. It may mean company which is into consumer durables also, right? Sector means, sectoral scheme means, for example, the banking sector, right? Or the pharmaceutical sector or the IT sector, right? So TCS, Infosys, Wipro, this forms part of the IT sector. SBI, HDFC Bank, Axis Bank, Kotak Mahindra Bank, this is the banking sector, right? Similarly, another kind of scheme could be fund of funds, right? Fund of funds. So just imagine, fund of funds means that the mutual fund scheme invests money in some other fund, right? It could be an international fund, or it could be another scheme of theirs. So they invest money in that scheme also, right? So fund of funds. Okay. And last but not the least, another one could be international funds, overseas funds, right? So just imagine there is an overseas fund which invests in companies abroad. It may invest in Facebook, it may invest in Google, it may invest in Apple, right? So if you want to invest overseas in, let's say, US companies, you can do that through mutual funds as well, right? So you choose to invest in a fund which invests in some other companies abroad, right? So mutual funds give you all kinds of different options. For example, when you go to a restaurant, you get a menu card, right? You have various kinds of recipes which are available there, right? You can choose whichever you want. Same is the case with mutual funds also. They give you multiple options and you can choose whichever you want, right? So let's first learn about the time flexibility basis scheme, right? Now, open-ended and close-ended. Open-ended means that it is always available. It's continuously on. Just imagine a bus which is continuously running, continuously running, continuously running. Imagine, whenever you want, you can get into the bus. Whenever you want, you can get out of the bus. Imagine, right? It's continuous. It is perennial. Okay? So this is a perpetual scheme, always on. Most of the equity schemes, they are open-ended schemes, right? Close-ended fund is such which gets launched at the time of NFO, right? And it closes. And thereafter, it would have a time, let's say 3 years from now, 5 years from now, when it will mature. Then it's like your FD, 3-year FD, 4-year FD. Once you have set up your FD, then you can get the amount matured only after a certain period. Right? That's a close-ended scheme. Okay. So in a close-ended scheme, you can get your money back only at the time of maturity. You cannot get it in advance, get it early. So there's liquidity risk there. Again, if you want to reinvest, you cannot do that once the scheme has closed. So imagine it's like a metro train. So once the doors are shut, you cannot get in. Can you? No, you can't. You can get out only after the doors get open. Right? So that's a close-ended scheme. Okay. Now, although the redemptions does not happen in close-ended scheme, but these schemes are listed on stock exchange, right? So you can check out what is the NAV. What is the NAV which is there? Because every day NAV would be released. It would be listed on the stock exchange, right? So you can get to know that what is my corpus become now? What is the amount it has become? All right. Interval funds have features of both open and closed. They are neither fully open nor they are fully closed-ended. Okay, so they have characteristics of both. For example, once the scheme starts after the NFO, you are told that fine, the scheme would again open after 6 months, right? So if you want to redeem or you want to enter, you can do that. Okay? It's like a train. So let's say a Chennai to Delhi train, it would stop at certain stations, 3-4 stations. So you know that these 4 stations are the ones where the train would be stopping. So those who want to get in, they can get in. Those who want to get out, they can get out. Right? So these funds thereafter could be redeemed, or you can again enter periodically, not every time. So it's not like open-ended scheme that whenever you want you enter, whenever you want you exit. No, but it is not fully closed also. Right? Okay. Now, how about classification by investment objective? Right? So let's say, like mother, many of you are mothers here. So normally I am sure you would have been cooking stuff basis the preferences of your children. And normally, please correct me if I am wrong, you may write in the chat box. Normally in a house, let's say if there are 2 children, the chances are that their preferences will also be different. One child may want X and the other child may want Y. Right? So they may have different. Normally, mother would be preparing both. It is normally said that the mother does not have her own preference. She does not have her own choice. People do not get to know normally what is it the mother likes. Nobody knows, because the mother never says that this is what I like. Right? She only makes things as per the liking of children and maybe the husband. Okay, so mutual funds have options. They would give you various kinds of of funds basis whatever you want. The first one is capital appreciation. Suppose you want good returns and you want that you should be able to get good accumulation. Obviously, the risk would be higher here, but you are willing to take that risk because you want higher returns. That's the investment objective which you have. Right? Somebody else may have a preference of an investment objective of capital preservation. The person says that my principal should not get lost. Fine, I may not get interest, I am fine with that, but my principal I must get. Whatever I am investing, that should be available to me. Right? That's another objective. Somebody may want regular income. So just like we learned about the debt funds, right? So there are income funds which are there where there are fixed income funds where you get regular income consistently. Okay. Then there are liquid schemes, for example, where if you redeem, if you give instructions to the mutual fund before 3 o'clock, and if you are withdrawing 50,000 rupees, the money would be available instantaneously into your bank account. You give the instruction and within 5 seconds, the money would be available in your bank account. There is very high liquidity in liquid funds. Right? So if somebody wants that, you can get that. Okay. Then there are tax saving schemes, ELSS, equity linked saving scheme, where you get benefits under Section 80C. Right? So mutual funds offer you, mutual funds are like mothers, so to say. They would prepare recipes basis the preferences of the children. Right? So they would have schemes as per the liking of their investors. Okay. So just to broadly share with you, you have equity schemes, you have debt schemes, right? Hybrid schemes are a combination. They could be a combination of 2 or more asset classes. Right? For example, a hybrid scheme may be such that it could be a combination of equity plus debt plus gold also. It could be such. Right? Normally, they are equity and debt, combination of equity and debt. So let's say there could be a scheme which has got 80% equity and 20% debt. There could be a scheme which has 50% equity, 50% debt. There could be a scheme wherein you leave it on the fund manager. If the fund manager thinks that now the equity markets are very low, right? He would shift maximum money to the equity markets. so that once the market goes up, you get higher returns. If the fund manager thinks that now the markets have, reached a very high level, he would shift maximum money to the debt side, right? So that when the markets come down, you don't lose much money, right? So the fund manager is taking a decision. You have dynamic asset allocation scheme that also is a part of hybrid, right? Similarly, solution oriented scheme, as I shared with you, children's fund or retirement fund, right? These are two examples of solution oriented schemes. Right? You may also have sectoral schemes and thematic schemes, right? Then you have index funds, you have ETFs, you have fund of funds. So those are examples of other schemes. So let's look at the scheme based on underlying portfolio. Scheme which is dependent upon, which is based on what kind of portfolio it has. Okay. So there are multiple options which are there, right? So within equity scheme, there are multi-cap, large and mid-cap, small cap, blah, 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 blah. Okay, in the first session, on the equity session, somebody had asked about large cap, mid cap, and I had said that we would discuss it on Monday. Madam, are you there? You had asked that question. Are you there, madam? Somebody had asked me privately and I didn't take the name. Madam, are you there? If you could just maybe send a message privately, that's fine with me.
Participants can even unmute and they can talk.
Now you can also unmute and speak, that's fine. Okay, it seems she is not there, it's okay. So we will discuss it again. Okay. Similarly, in debt fund, there are multiple kind of funds. We will discuss that. Hybrid, there are different types, right? Again, solution, as I mentioned, children's fund and retirement fund. So multiple schemes are there. Now, broadly speaking, in equity, broadly, you have large cap, mid cap, small cap, and multi cap. Right? Now, what does it mean? What are the large caps? Remember, we learned about market cap, market capitalization, right? Market cap in the session on equity, right? Market cap is price of share, market price of share multiplied by the number of shares outstanding. Pardon me for my handwriting. Multiplied by number of shares outstanding. Right? That's the market cap. Right? Now, the top 100 companies in India, in terms of market capitalization, top 100, 1 to 100, they are large cap companies. So this fund would be investing 80% of its money, in large cap companies. Right? Balance 20%, it can invest in other companies also. That's what a regulation allows them to do. But 80% has to be in large cap. Right? Who are large cap? 1 to 100 in terms of market cap. So all big companies. Okay. Mid cap. So again, in terms of market capitalization, those companies which are 101 rank, right, to 250 rank. 101 to 250th rank in terms of market capitalization, they are mid cap companies. Right? Now, the fund would be investing 65% in mid cap. Balance 35% it can invest in large cap also. But 65% has to be in mid. Right? Small cap companies, what are small cap companies? So 250th rank, 251st rank, 251st onwards. downwards. Right? So these are those companies which are not very big right now, but going forward they will become big. Right? 251st rank and below. So these are mid cap companies, small cap companies, I beg your pardon. Right? So 65% would be invested in these companies. Okay? Multi-cap, as the name suggests, it could be across all these companies. Right? It could be across various kinds of companies. Okay, I hope it stands clarified. Okay, so as you could see, minimum 65% in equity and equity related instrument. Minimum 65% has to be in equity. Okay, balance 35% could be in debt also. Large cap, as I mentioned, 80% has to be in large cap. Right? Mid cap and small cap, minimum 65% in mid cap and small cap. Right? There's another one, large and mid cap. So that's combination of large and mid cap. So it means from one largest market cap company to up to 250. Right? Remember, mid cap is 101 to 250, which means rank 1 to rank 250 is large and mid cap. Right? So in this, 35% has to be in large cap and 35% has to be in mid cap. Similarly, other schemes are also there. For example, let's say the investor wants money to be invested in only those companies which are high dividend yield companies, which pay high dividend. So generally all public sector companies, ITC, Nestle, Hindustan Unilever, all these companies which have a track record of a very high dividend yield. So the fund would be investing money in those companies. Right? Value fund means with the basically fundamentals, where the fund manager thinks that the current price of the stock is less. Going forward, the stock will be very high. Right? So these are maybe the fund manager thinks that these are like gems which are available at a very attractive price right now. Right? So 65% of the money has to be invested there. Contra one is those one which the market think that they are not doing well. Those companies will not be doing well, but the fund manager thinks that no, I think he has got a great potential. These companies have a great potential. Right? So it's a contrarian strategy. Focused fund would be, would have just 25 or 30 companies. Just 25 or 30 companies. A fund which is focused, right? Which has only 25 to 30 companies. For example, let's say there is a particular tutor who says that I will have only a batch of 25 to maximum 30 people, 30 children, right? So that's a focused fund. But this may have concentration risk, right? Because let's say if it's a large cap, 25, 30 companies, then obviously if anything goes wrong, all of them will get impacted. So 80% is, 65% is in maximum 30 companies, right? Sectoral thematic we have discussed. ELSS as we discussed, this is from a tax saving perspective, right? So the minimum lock-in period is 3 years, but you get 80C deductions. Okay, before we come to risk reward ratio, let us quickly go to moneycontrol.com. Give me a minute. So let's look at the various kinds of schemes and just to give you a practical perspective. All right, so I'm connecting you to the presentation now. Okay, so I am on this. So just go to moneycontrol.com. Okay, so here, as you could see, I hope you can see the screen, right? Can you see moneycontrol.com website? Can you see the moneycontrol.com website, please? Okay, thank you. Thank you for the confirmation, right? So what you do is go to mutual funds, right? You see mutual funds here? Just go to mutual funds, right? Now, all right. So happening. Yeah. On mutual funds, just go to top ranked funds. Okay. So you go to top ranked funds. Okay. Now you see what we discussed. So we said there are multiple equity schemes. There are multiple hybrid scheme, combination of equity and debt. There are debt schemes, right, which we will be learning about. And then there are other schemes. So fund of funds, solution oriented, right, like that. Okay. So let's go to equity scheme. Okay. Now you want to check out, let's say all 5-star rated schemes. Okay. So you go here. And you see there are multiple types of schemes are there. Okay. There are multiple types of schemes which you can see. Now you can choose here what kind of scheme are you looking for. Okay. So here you can choose. Okay, sorry. You go to performance tracker, because if you go to go to performance tracker, and you see here there are multiple kinds of categories which you see within equity, right? So you see multi-cap, small cap, contra fund, large cap, ELSS, focused fund, whatever we learned about, right? So you see all those schemes here. Now let's say you want to check out about large cap scheme. So you opted for large cap scheme, right? And you will see multiple types of large cap scheme. Now, for example, these are all 5-star rated funds, right? So you have Franklin India Blue Chip Fund. You have Axis Blue Chip Fund, right? You have various kinds of schemes here. Similarly, you want to check out about large and mid cap scheme, you can check out about those. You want to check out about mid cap scheme, you can check out. You don't need to remember anything. The technology will make your job easier, right? And you see about sectoral or thematic scheme, you can check it out. There are various types of schemes which are available. So I just wanted to show to you, this is what we discussed and this is how you check out, right? You want to check out about the tax saving scheme, you go to ELSS schemes, right? ELSS scheme. You want to go to focused fund, 25-30 stocks in the portfolio, you can go to focused fund, right? We will come back again when we will learn about the passive funds and active funds. Okay. Now, we learned about the risk. Let's now learn about, so we learned about various types of schemes. So now you tell me which scheme would have the highest risk. So we learned about large cap, mid cap, small cap, multi cap. We learned about dividend yield. We learned about contra. We learned about value. We learned about sectoral, thematic, etc. Which one would have the highest risk? Any idea? Which one do you think will have the highest risk? Mid cap. Okay. Let's check it out. Let's check it out. So the sectoral funds would have the maximum risk, but then they would give you high returns also, right? So this is the return potential on the y-axis, and on the x-axis you have the risk, right? So this is the risk reward, from a risk reward perspective. This is the risk reward trade-off which is there, right? So large cap funds would have minimum risk in equity, and then large and mid cap fund, then multi cap fund, then dividend yield fund, then value and value or contra, then ELSS, then focused, then mid cap, right? Then small cap. So small cap would have the highest risk in terms of the ones in terms of market capitalization. But sectoral funds or thematic funds would have the highest risk because these are cyclical in nature. It's quite like look at automobile sector. For the last 2-3 years, is the automobile sector working properly? No, it isn't, right? So auto sector had got hit even before the pandemic. So imagine somebody investing money in auto sector. Obviously, those sectors would have been underperforming. That sector would have been underperforming, right? Steel sector is doing very well. Metal sector. So if someone would have put metal sector or pharma sector, they would have done very well. Or the banking sector, they would have done very well, right? Now, how do you know how much is the risk? So SEBI has made our job easier. SEBI has mandated the mutual fund companies to provide a riskometer. So every mutual fund scheme would mention about this riskometer. So even someone who is not educated, right, can make out what is the level of risk. So it is across 6 levels, right? From low to moderate, moderately high, high to very high. So the sectoral or thematic funds would have the indicator here, very high, right? Liquid fund would have it here, low, right? So you can purely look at the riskometer to get an idea as to what would be the level of risk in the scheme, whether it is high or whether it is low, right? So whenever you invest money, always look at riskometer also. Quickly speaking, let's also learn about debt funds. Okay, so debt funds would be putting money. We learned about it, right? Various kind of debt instruments, right? Bonds, money market instruments, treasury bills, certificate of deposits. We learned about all this. Okay. So debt are generally income generating instruments. So anyone who wants income to get generated in the investment objective, obviously may be focused more on debt funds, right? So as we discussed at the beginning of this session, here you will be getting returns in terms of income. You may be getting monthly or quarterly or half yearly, depending on what you have opted for, or it could only be at the maturity, right? So what are the benefits of debt? Your portfolio gets diversified risk allocation. So maybe you invest 70% in equity and 30% in debt. The risk exposure is lesser. You can invest in smaller amounts also, just like equity and debt also you can invest in smaller amounts, right? You can get regular income. You can also park lump sum money. Suppose you have lump sum money, you have got bonus from your college, right? You can invest the lump sum money there in a liquid fund or in any overnight fund, right? The return here is prevalent with the is in line with the prevailing interest rate. So what are the kind of schemes which are there in debt mutual funds? Okay. So there are multiple schemes. You should invest in this scheme considering your horizon of investment. Whether you want to invest from a long-term perspective or whether you want to invest from a short-term perspective. Right? So you have multiple kinds of schemes, right from investment for a one-day perspective to 10 years and 10 years plus perspective. Right? There are multiple types of schemes which are there. So you can invest in these particular schemes. So let's say you want to park your money in emergency fund, then in that case, liquid fund would be better. For anything which you want to park for a maturity up to 91 days. Right? For 3 to 6 months, ultra short duration fund. For 6 to 12 months, low duration funds. For up to 1 year, you have money market funds. Right? So different kinds of schemes are there. Tomorrow, we shall also learn about the concept of duration as to how much do interest rate changes impact the price of a bond. Right? So we learned about the fact that if the interest rates go up, right, the price comes down. If the interest rates go down, the price of bond goes up. How much does it get impacted is what we shall learn about tomorrow. And what is the significance of that thing when it comes to investment in debt markets? We shall learn that also. Okay. All right. So hybrid funds are a combination of equity and debt, both. Okay. So you have conservative hybrid fund where only 25% is in equity, 75% is in debt. Right? So let's say there is someone who says, no, I don't want to take much risk. I mean, for me, my retirement is just about 4 years away. For me, I would only want to keep very limited amount of liquidity in my investment. I would want to invest only a limited amount in equity in my portfolio. And the balance, mostly it should be in debt. So for that investor, conservative hybrid fund would be better. Because here the equity exposure is only 25%. Right? Somebody says, no, I want 50-50. Right? I want 50% debt, 50% equity. Somebody said, now most of the investors would say that, okay, equity should be minimum 65%. Balance 35% would be debt. So automatically, my asset allocation ratio would also get taken care of. Right? So for them, aggressive hybrid fund is better. What are solution-oriented funds? Okay. Quickly, we have discussed it quite a few times today. Please write in the chat box what are solution-oriented funds schemes. Which schemes are called as solution-oriented schemes? We discussed it today. Yes, retirement planning and education. Education. Right? Children's education. So children's education and retirement planning, they are solution-oriented. Okay. So retirement fund and children's fund, right? They have a lock-in period of 5 years. So liquidity risk, right? So ELSS and retirement scheme, you have a slight liquidity risk considering that there's a lock-in period. Right? But if somebody is nearing the retirement, let's say 55 years, then that person can withdraw money in a retirement scheme. Other funds. So as we discussed, index funds or ETFs and fund of funds. Right? Plus, so these are the two schemes. right? Solution oriented would also, have these days there are also in these when we discussed about sectoral and thematic, right? In the equity schemes, you also have ESG schemes, ESG scheme. So they're also doing very well. You may consider parking some money. So what are ESG schemes? E stands for environment, right? S stands for sustainable, right? And G stands for governance. Governance, right? Environment, sustainability, and governance. So this particular fund would invest money only in those companies which focus on the green projects. They focus on water conservation. They focus on environment protection. They focus on inclusiveness, right? For example, they say that we are employing LGBT people also. They say that we are employing disabled people also, right? These people are known to focus on certain social causes also. They may not invest in tobacco ITC. ECG funds will not invest in ITC, right? They will not invest in any pan masala company. They will not invest in any liquor company. So these are ESG funds, right? They would invest in those companies who believe in sustainability, who believe in environment protection, who believe in corporate governance, good corporate governance, right? So ESG theme is doing very well these days. These funds have shown very good returns. Okay. Just a minute. All right. Okay. Now we had also learned about indices in the session on equity. We learned about Sensex. We learned about Nifty, right? So this we shall learn about in other funds. We shall learn about when we learn about passive funding, passive investment, right? But then other funds are also about fund of funds. So they may invest in some other mutual fund also. Here they may invest in some international fund also, fund of funds, right? Now, when it comes to investing money, there are two strategies in case of mutual funds. One strategy is active strategy, and the other strategy is passive strategy, right? This is important. I would request your attention here. So what is active strategy, right? See, active strategy, just to give you an example, let us say the average return in Sensex and Nifty, right? Let's say the average return has been 14% in a particular year, right? So the active strategy says that if my fund is, following an active strategy, the fund manager will say that if the market has given 14% return, we want to get more than 14% return. Let's say we would want 17% return. So our fund want to give return higher than the market. Example, let's say in a particular city, the average pass percentage is 90%, right? Now your college may say that no, if the average is 90%, we want our college results to be minimum 95%, right? Why? Because we are different from other colleges. We are special. We have got a great faculty. We have got a great legacy, right? Look at that, I'm sure you would have heard of that Super 30 coaching institute in Patna. Movie was also made in that, in Hindi, a movie was also made in that, on that particular person, Dr. Anand, right? Now that Super 30 coaching institute prepares the students for IIT admission, and they have a reputation that 30 out of 30 students, the entire batch, year after year, they get admission in IIT. Have you heard of it? Super 30 Institute. I'm sure you would have. You are, professors. I'm sure you would be aware about it, right? So that's the kind of reputation they have. So they are not concerned with what others are doing. They say we don't have any competition with them, right? We don't want 10 out of 2000 or 5 out of 2000. So other institutes, they would place full page advertisements in the newspapers that 4 of our students have qualified for IIT, right? They say we don't care about them. In our case, it has to be 30 out of 30, right? So active fund says, an active fund with active following active fund performance says that we want to get returns higher than what the market is giving, right? So let's say the market performance is like this. So let's say the performance of market is like this, right? They say that we want our fund performance to be like this. Our fund performance has to be higher than the market. So that is actively managed fund, where the fund manager is focused on a superior performance as compared to the market, right? A passive managed fund would have the performance in line with the market. More or less, the return will be in line with the market, right? So whatever the market is giving returns, we would follow that, right? Our fund performance would be mirroring the performance of the market. That is passive investment, right? So active fund management means the fund manager will choose stocks which may be different from their composition in the Nifty. Remember, we learned about the fund's weight in the Nifty. Of Reliance has, let's say, 10% weight. HDFC Bank has 9% weight, right? But here the fund manager will say, fine, if a particular stock has a 5% weight in Nifty, but if I think that that stock has great potential, I would want 10% of that fund in my portfolio, right? So here the fund manager would focus on giving higher returns than the market. Okay, so every fund is linked to a benchmark, right? So just to give you an example, a large cap fund may be benchmarked to, let's say, Nifty 100, right? Nifty 100 total return index. But what is total return index? Remember, we learned that other than Wipro example, so other than what the corpus, what the stock, what the investor would have earned in terms of the price movement, the investor would have also got dividends. So the total earning of the investor is capital gains plus dividends, right? So the total return index includes the dividends also which the companies would have given. So total, how much is the return, right? Now every fund is benchmarked to a particular index. The objective is that they would want to give higher returns than than the index. For example, I am sure in your college, every student may have a particular role model. Maybe one particular girl in your college in a particular class could be the role model for others. And every student may have been thinking that I want to do, as good, if not better than this particular girl. So this girl student becomes the benchmark for the entire class, right? People say, I want to do it better than that. I am sure in your college, a particular faculty member could be benchmark for everyone, right? Everyone may have that particular faculty member may have been very popular with the students. Students love the way he or she teaches, right? And I'm sure other faculty members may have been wanting to do better than that particular professor. Example, right? Similarly, R. Ashwin could be the role model. Ravichandran Ashwin is the role model for all these spinners in the country today, right? Everyone wants to break R. Ashwin's record, right? Today, Neeraj Chopra would have been the role model for all athletes in India. That's benchmark. So the fund manager would have been wanting to give a higher performance beyond the benchmark. Okay. So whatever extra return that they get over and above the benchmark is alpha. So example, let's say the Nifty has given 14% returns. And if this corpus, this fund has given 17% return, then alpha is 3%. It's called as Jensen's alpha, right? If not today, tomorrow we'll go to moneycontrol.com and we will see the alpha against every fund, right? You will see how much is the alpha. Okay. A minute. Now, these funds, because they are wanting to do better, obviously they will have much better fund manager. The research team will be more robust. Their expense ratios are also high. Right? For example, if you get your child admitted in a reputed coaching institute, right, their fees will also be higher. But then they, if you make them study there, the chances are better that they will do better in their NEET examination or IIT examination, right? Their expense ratio. Okay. For example, ICICI Prudential Blue Chip Fund, Axis Blue Chip Fund, HDFC Top 100 Fund. These are all actively managed funds. Here, the fund managers try to give a higher performance as compared to the benchmark, right? So what are the common benchmarks against which mutual funds would benchmark themselves? So, in a large cap, it could be Nifty 50 total return index, right? In a large cap fund, again, it could be BSE Sensex TRI. In a large and mid cap fund, it could be BSE 200 TRI. In a large and mid cap fund, it could be Nifty 200 TRI, total return index. Mid cap fund may have Nifty mid cap 250 because there are first 250 companies, right? Small cap, 101 to 250 is the mid cap, right? Small cap, it would be Nifty small cap 250. So the fund manager would check out the performance against the benchmark, right? Again, in debt funds, again, it would either be 10-year government securities, the yield against 10-year government bond, or it could be CRISIL composite index. Right? So let's check this passive strategy, and then we'll go to money control for a few minutes, and I will demonstrate it. Now, passive strategy is to give returns in line with the benchmark, right? In line with the market returns. Okay. Here, the fund manager would purely be following the benchmark. Okay. And I'll explain how does it do that. Okay. So the purpose is to give the returns in line with the market. Okay. Now, you learned about Sensex and Nifty. We learned about Sensex and Nifty, right? We learned that Nifty has is a basket of 50 stocks. Sensex is a basket of 30 stocks, right? We learned that in Nifty, the companies are in a certain ratio. Now, just think about it. In a Nifty fund, because Reliance has a weight of 9.63%. If you are doing an SIP of 10,000 rupees per month, right? The fund manager would invest 9.63% in Reliance. So out of 10,000 rupees of yours, 963 rupees would be invested in Reliance. Right? 9.11 is the ratio for HDFC Bank. So out of 10,000, 911 rupees would be invested in HDFC Bank. 874 rupees would be invested in Infosys. So on and so forth. Right? So it's just a matter of process. Here, the fund manager will not be taking any active calls. The fund manager would be investing purely in line with that. For example, let's say you have taught your children to prepare a recipe, right? So if you tell them that put this much of oil, put this much of salt, put this much of spices, right? Your children also do that. Okay, so that's a passive strategy which is there, right? Similarly, if it is a Sensex based fund, right? Then again here, if Reliance is a weightage of 10.51% and it's a Sensex based fund, then 10.51% would be invested in Reliance, 9.95 would be invested in HDFC, so on and so forth. The purpose is to get returns in line with the market. That's a purpose. Okay, that's passive investment approach. Now, because it's purely a matter of process, the fund management charges here are very less. Right? So if you don't want to take much risk, if you want to get returns in line with the market returns, this would be a good strategy. In fact, it would be a good strategy to earmark, let's say, 15-20% of your portfolio towards Nifty, towards passive fund. Right? To start with, when you are a beginner, it's not a bad idea. Okay. Exchange traded funds are also. Exchange traded fund is, you could understand it, it's a share in itself. Right? So let me give an example to you. Imagine you are, do you know laddu? I don't know, whether it is called laddu in Tamil or what is it called? A laddu, right? Any sweet, anyone, if anyone is familiar with Hindi, what is laddu called in Tamil, please? Anyone, please, if you could help. Oh, it's called laddu itself, huh? All right, so you understand what is laddu. All right. So just understand you have a laddu, right? So let's say a laddu, is supposed to have this much of protein, this much of carbohydrate, this much of fat. Just imagine. So just imagine that Nifty right? All the ratios, all the 50 stocks, are inbuilt into this ladder. Imagine, right? A Nifty ETF would have all the companies invested in a certain ratio within one share. That's exchange traded fund, right? If it is a Nifty one, it would have 50 companies in a certain ratio. If it is a Sensex one, it would have 30 companies in a same ratio. So when you get one laddu, right, you are getting 30 companies in a certain ratio. If it is a Sensex ETF, if it is a Nifty ETF, you are getting 50 companies in a certain ratio, right? That's exchange traded fund. I've attempted to explain it in a simple manner. I don't know, whether I've been able to do that or not. So portfolio would represent a benchmark, right? Nifty or Sensex. It's first issued at the time of NFO and then available thereafter, just like any other scheme. And it's available in your demat account, right? So ETF is necessarily available in your demat account. Just like you buy shares, you can you can buy ETF also. Okay. So example, UTI Sensex ETF, SBI ETF in Sensex, SBI ETF Nifty 50, Aditya Birla Sun Life Nifty 50 ETFs, etc. Every mutual fund has ETF. Okay. Now, what's the advantage of investing systematically? So in equity, you should never invest in lump sum. I would recommend that do not invest big amount. Let's say, more than, I would say more than, 20,000 in lump sum, please do not invest, right? Unless you have, let's say, a huge amount and you want to invest it in, let's say, 25,000. I would recommend to you that at the most 20,000 should be the lump sum amount, right? Try and invest systematically. That's the best way. What's the advantage? Because when the market goes down, you are able to get the units at a lesser price. So just for example, let's say the market is, you are investing 10,000 rupees monthly, right? Now let's say after first month, the unit is at 10 rupees, NAV is 10 rupees. So you will get 1,000 units. Let's say next month, the NAV goes down to 8. Now you get 1250 units, you get more units. Next month again, let's say theoretically speaking, the market goes down to 5. Then you get 2,000 units, right? So when the market is going down, you are getting more units, right? And when the market is going up, your portfolio value is going up, right? So while your average unit value is limited, so you've been able to get, 29,333 units for just 1 lakh. So your average per unit is just around 3 rupees, right? So once the market reaches 12, your portfolio value will be 3.5 lakhs, right? So that's how it works. Okay. So let me just quickly take you to moneycontrol.com. Just a minute, please. All right, so we are at moneycontrol.com now. So remember, I mentioned actively managed fund and passively managed fund, right? We discussed about the benchmark. We discussed about the returns, alpha, right? Let's see this now. So let's go to a large cap fund. Okay. Let's go to Axis Blue Chip Fund. It's an actively managed fund, right? Now just check out. So this is a direct plan. I'll explain about direct plan and regular plan also, right? So the expense ratio is 4.9. Okay. Riskometer is mentioning you that the risk is very high. Okay. You see that now you go to, now you see benchmark. So it's Nifty 50 TRI. So it is mapped to its benchmark to Nifty 50 TRI, right? Now you see the performance. So the blue represents the scheme, right? Now in the short period, the scheme seems to have underperformed the benchmark. Okay. So while the benchmark has given 46% return, the scheme has given lesser return. And that's because the market has of late been quite, behaving in a quite unique manner. So this is as of now. But if you compare over the for a 2-year period, right? So 2-year period again, the benchmark is slightly higher. 5-year period, yeah, here you see that the scheme has clearly above the benchmark, right? Over a 5-year period. Remember, equity schemes are from a long-term perspective. We need to invest in equity from a long-term perspective. The real comparison is from a long-term perspective, not a short-term perspective, right? And this is a live example in front of you. So see here, the scheme has performed much higher than the benchmark, right? And when you go to analysis, you will see the alpha. So this is the alpha, right? So the scheme has given, from a long-term perspective, 2.4% alpha, right? While the category average, while the other schemes in the category, right? So this is how you can compare how has this scheme performed as compared to the benchmark. Okay, let's now see the performance of any exchange traded fund. So we go to others, okay, and we go to ETFs, index or ETF. All right, so let's check out UTI Nifty Index index fund. Okay. So sorry, this scheme is not there now. Sorry. Okay, we have HDFC Index Direct Plan. Is this scheme there? This is also, yeah, this is there. Okay, so you see here this scheme would have almost, see, the performance is level. See here, right? This scheme's performance would be in line with the market. So the benchmark is BSE Sensex TRI. So this is a Sensex based scheme. It is mapped to Sensex, and here the performance is in line with the benchmark. So this is an example of passive investment, right? Let's see another example of active fund management. So we see here a particular equity fund, and let's say a mid-cap fund. Let's see a mid-cap fund this time. Okay, and let's check out Kotak Emerging, SBI Magnum, or let's say Kotak Emerging Equity. This one we check on mid-cap fund. Okay, so what's the benchmark? So the benchmark is Nifty Mid-Cap 100 TRI. So they have mapped it to Nifty Mid-Cap 100 TRI benchmark, right? And look at the performance of the scheme. This is beyond the benchmark, right? So this scheme has performed better than the benchmark. They have given a higher return as compared to the benchmark. So you will see alpha also here. Just see here. Yeah, so see, they have given 6% alpha. The scheme has given 6% alpha as compared to the 4% of the category. So the scheme has given higher alpha. So here you can choose a scheme which is a better performing scheme. Tomorrow we shall also learn about standard deviation, Sharpe ratio, Trainer's ratio. and beta we shall also talk about. So it gives you the complete knowledge. Hopefully, this particular knowledge would help you take informed decision yourself. Okay. All right. So how can we analyze the performance of the fund? First, you can see against benchmark. So today onwards, if somebody tells you invest in XYZ scheme, do not act on it before analyzing the performance of the scheme. Go to moneycontrol.com. There is value research online. There are multiple websites, right? You can check out on your own. You can also see their portfolio of the scheme. Where is the scheme invested in? I missed out showing you the portfolio. I'll check. I'll show it to you tomorrow. Okay. And then you can compare the risk-adjusted return, which we shall discuss tomorrow. The standard deviation, the Sharpe ratio, the trainer's ratio, right? That would help you get, considering the risk which the fund has taken, how much of return it has given. And you can also compare how is the performance of the scheme vis-a-vis its peers. Right? Plus, you can also see who's the fund manager, how much, what other schemes is he managing, how is the performance of other schemes. Tomorrow, we should also check out mutual fund fact sheet, right? So the fact sheet of a particular fund house would carry complete information, expense ratios, who's the fund manager, what other schemes is that fund manager managing, what is the experience level, etc., etc. Right? See, let's accept it. Investment is not a complicated thing. It is just that you will need to take more interest, right? And after all, yours the hard-earned money. You guys slog day and night, earn the money which you are earning. So we need to make sure that we manage that money properly, right? Let's not invest money just because somebody is asking us to invest. Because unfortunately, in this world, there are a lot of people, and I'm sure you will agree with me, who are ready to take advantage of your money at your cost, right? So become your own boss, take your own decision. Today we have technology. You can just go, and it will not take 4-5 minutes, 7-10 minutes to do that analysis. And once you are confident that this is a good fund, you can go ahead and invest in that, right? So you compare it against the benchmark. Okay. So alpha means it has given excess returns over the benchmark, right? Beta would indicate how much the volatility as compared to the market. If beta is more than 1, it means that it is more volatile. But then it also means that if the market has improved by 5%, your fund may be doing better than 5%. Right? So it's about how much of risk can you take. Depends upon your risk appetite. Okay. So risk-adjusted return, I showed you that we saw Sharpe ratio, trainer's ratio. So this is again something which we shall discuss tomorrow in detail. Now the whole objective is to take to get higher returns for the kind of risk you are taking. Your risk-adjusted return should be higher. Okay? Like for example, if you are making your children study in a good coaching institute, right? Then you would expect better results, no? For the given fees which you are paying, you would want higher output. Simple, right? So the lesser risk funds which have lesser risk, may have higher returns. But it depends upon how much risk, how much return is the fund giving for the given risk it is taking. Right? So we will check out Sharpe ratio and trainer's ratio. The higher the Sharpe ratio and trainer ratio is, the better it is. As we learn it tomorrow. Okay. So we shall do that. Okay. Again, standard deviation. So what is standard deviation? So standard deviation, okay, let me ask you a question here. Let's say in a particular class, there are 5 students, just to give you an example, right? So there are 2 classes, A and B, right? In one class, the marks are, let's say, out of 100, 80, 70, 90, 95, 100. Okay. In another class, the marks are 90, 95, 94, 92, 90. Right? Where, which particular class would have a higher consistency? Which particular A or B would have higher consistency? Please tell me. Where would you see is the risk? Yeah, B, right? B would have higher consistency, right? So the risk would be lower. So if a fund has given consistent returns, then the standard deduction would be lower. Standard deviation would be lower, right? But if the fund is being, in terms of returns, the returns have been very uncertain, the volatility has been very high, then the standard deviation would be higher. Right? The lower the standard deviation, the better it is. Higher the Sharpe ratio, better it is. Higher the trainer ratio, better it is. Okay. So we shall learn about it tomorrow. Yeah, we shall learn this tomorrow. You can also compare the performance against the peer, right? Plus expense ratios, which fund has comparatively a lower expense ratio, right? But again, this you would see in line with how's the performance. You wouldn't mind paying a higher expense ratio if a fund is giving you higher performance, right? This also we shall check out tomorrow. Direct plan and so direct plan and regular plan we'll discuss tomorrow. Sharpe ratio, trainers ratio, beta and standard deviation we shall learn tomorrow. Duration we will learn tomorrow. We shall also learn about the bond yield in more detail tomorrow. Right? This is what we learned today. We shall. This is incomplete. We shall check out more things tomorrow. If there are any questions, I'll be happy to answer. Any questions, please? What is reason for tenure for gold bond scheme? That is okay. So gold bond scheme, the government has fixed a tenure of 8 years. You can redeem it after 5 years also. It's not that you cannot redeem it before 8 years. You can redeem it before 5 years also. But gold is, an asset class which you should hold on for some time. Then only it will give you maybe some decent returns, right? I would personally recommend to you that hold it on for 8 years. There will be no capital gains. Plus, you are likely to get higher returns after 8 years. The government has designed it that way, so it's a scheme. But I would recommend that, personally speaking, I would recommend that you put only that money, you invest only that money which you can manage, to hold on for 8 years. Any other question, please? Thank you so much, madam. Appreciate, glad you liked it. Thank you. Thank you so much. Yes, sir. In fact, sorry, I can't make out from the name whether it is madam or sir. Apologies. You are absolutely right. trust me, investment is more to do with the behavioral management
ஒரு 4 மணிக்கு கிளம்பலாம்.
than the skills. Right? It's more about the behavioral management. Many a times we
light
take
out,
decisions. Okay, somebody's mic is on. If you could mute it, please. Many a times we invest without taking, without doing analysis, without paying attention, and obviously we may not be able to manage it properly. Okay, sir, someone had asked this question about effective yield. Are you there today? We had discussed it, but then at that time you were not there. Somebody who had asked this question about effective yield, are you there today, sir? If you could just mention in the chat box. Yes, madam, they are absolutely safe. Safe in the sense, please do understand that, gold after all, is, it depends upon the returns which it has given, right? But that's why 8 years is a sufficiently long period. I personally think that gold prices right now are really down. That's my personal opinion. I personally think that in 8 years' time, gold should be giving good returns right now because see, there's a lot of liquidity which is there. So US has pumped in a lot of money. They have paid around $2,300 to every citizen, US government. They have given loans almost at 0% interest to the businessmen there, right? So there's a lot of liquidity there. So they are preferring equity markets more. But going forward, God forbid, any uncertainty comes, gold is the one people would focus on, right? So I personally don't think gold prices would come down drastically. It's absolutely safe. You get 2.5% interest also, other than the chances of capital gains. So personally, I would recommend, but I would recommend do not put more than 10% of your portfolio. Okay, yes, please. Effective yield. Sir, were you the one who had asked this question yesterday? Okay, sir or madam, whatever. So let me explain it to you. See, let's say you are getting the returns from a bond. You are getting the coupon rate on a monthly basis, or you are going to get the coupons interest rate on a quarterly basis, right? Then effectively you can get a higher rate of return. Your yield will be higher because you can reinvest that money, right? Let's take an example. Let us say I put 10,000 rupees in a bond. I get 6% rate of interest, right? So every year I get 6% interest. So which means 600 rupees. Now assume that the interest is payable on a half-yearly basis. So I get 300 rupees every 6 months. I can reinvest that 300 rupees, right? So every 6 months I can reinvest 300 rupees. So effectively the yield will be higher, right? As compared to if I were to get the coupon rate only yearly. Still, if I were to get the interest amount cumulatively after whatever period that particular investment is for, right? Imagine I get interest plus payment for all the years at the same time, then the yield will be lower because I have not been able to reinvest the money. I hope it stands clarified. Okay. I'll just share the quiz. Just a minute, please. All right, so I'm just pasting it. Yes, madam, absolutely safe. See, safe in the sense that do not invest in lump sum. Right? Equity, do not invest lump sum. Invest systematically. Right? So when you are investing systematically, as we discussed, if the market is going down, you are going to get more number of you'll be able to buy it at a lower value. This results in averaging, right? So that's the advantage of systematic investment. Equity should not be for lump sum investment. There's a risk in lump sum investment. Welcome. Okay, kindly take the quiz, please. And again, my request to you, kindly do not resubmit the answers. Now you can see yesterday also, everyone could have seen the correct answer. So there was no point resubmitting the answer. It adds to the work. Seriously, it does add to the work. That's a humble request from my side. Secondly, kindly put your the same name which you have been using. Yesterday, some people use different name as compared to what they were putting earlier. So kindly put the same name, same email ID and same mobile number, because otherwise it's not possible to track it. And I'm sure you would appreciate that. Thank you.
Thank you so much, sir.
Welcome.
As Douglas would said, the heart that gives thanks is a happy one, for we cannot feel thankful and unhappy at the same time. So we all thank you for this wonderful session for today. Thus, to conclude, I request Mrs. E. Irfan Meera, Assistant Professor, Department of Business Administration, to render the vote of thanks.
First of all, I thank our Chief Guest, Mr. Ravindra Singh Chawla, founder and managing director, RSG Schemes, for creating phenomenal awareness on how to create wealth. Sir, I follow your vision and your vision on the increase my financial knowledge, but also I got inspired by your remarks and your good way of presenting stuff like. Thank you so much, sir. I would also like to extend my gratitude to our management, our correspondent, our director, Dr. Sarkar, our program coordinator, computer, Dr. Sivasan, staff of the staff members who make the mission efficient and valuable. Thank you.
Madam, you're not audible.
Ma'am,
You're not audible.
You're not audible.
Hello. Am I audible now?
Ma'am, little bit louder.
Am I audible now, ma'am?
Yes, you are.
Oh,
Madam.
okay. Should I start from the beginning?
Yeah,
As you wish, madam.
Okay, sir. A warm and lovely evening to all. It's my privilege to propose a vote of thanks on behalf of SA College of Arts and Science. First of all, I thank our Chief Guest, Mr. Ravindra Singh Chawla, founder and managing partner, RSG Skill Building and Consulting Solutions LLP, for creating phenomenal awareness on how to create wealth with mutual funds. Sir, I've been diligently following your sessions, and your sessions not only increased my financial knowledge, but also I got inspired by your remarkable teaching, knowledge, and your life. Thank you so much, sir. I would also like to extend my gratitude to our management, our correspondent, Raja, our principal, Dr. Malati Sarvakumar, our director, Dr. Sai Sundari, our program coordinator, Dr. S. Ganapati, computer, Dr. S. Sivasankari, staffs of SA College of Arts and Science, and staff members from other institutions for making the session effective and valuable. Thank you once again.
All right. Thank you very much. Some people have earlier also somebody had written that I could not take the quiz earlier. See, unfortunately, the responses in terms of acceptance of we are not accepting responses to yesterday's quiz now, right? Today again we'll not accept responses after 6 o'clock today. So kindly take the quiz there and then, because as you know, we have to have the same rules for everyone. So we cannot have it unless I'm instructed differently by the esteemed hosts. You're not. I'm not. The responses are not being accepted now for yesterday's quiz. So it's only for today's quiz which is being accepted. So I request you to kindly take the quiz now itself. Trust you will appreciate that these things are important. Otherwise, if responses keep coming forever, then it cannot be managed. Thank you so much for your understanding. Appreciate it.
Thank you.
Thank
Sir.
you. Looking forward to meeting you tomorrow. Vanakkam. Namaskar. Thank you.
Thank you. Thank you, sir.
A gentle reminder, we request the participants to attend the quiz before 5 p.m.
Yes.